Hi folks, I thought today we'd have a quick look and see at margin calls. That's what I call the investor's shark bite. There's a really great movie on at the moment with Kevin Spacey. It's called Margin Call. He's such a great actor. American Beauty, Usual Suspects. But the movie Margin Call really doesn't deal with margin calls. It's more about the stuff leading up to the 2007 market crash. And this video is about the hidden dangers that lurk. There are just two words that all the players in the investment field just don't want to hear. Yes, of course you guessed it, margin call. Now we're talking some seriously scary stuff. These two words carry out some heavy duty meaning. Firstly, it means the value of your investment has dropped. It's gone south. And the margin loan, the thing that you use to buy the investments, is now due and payable. It also means that you have to act fast. You've just 24 hours to find the money and pay it. Because if you don't, they're going to sell your investments. And that is financially going to bite you in the leg. Okay, let's step back for a moment. We know that a margin call is not good for us, but how did we get here? Well, it all started when you wanted to borrow some money to buy shares, using the shares as collateral security. It starts with the margin loan. Let's imagine you're reading an investment brochure about a mining company who dig great big oranges out of a hillside. It's called the oh-so-sweet Orange Mining Company. Why wouldn't it? As you read, you see that the lender will lend 70% of the value of the share. That's cool. You know that the share price is $150, quick calculation, and all of a sudden you can see that you can borrow 1,000 shares for $105,000. All your numbers are confirmed in the table. The higher the price, the more they'll lend. Cool bananas, cheaper at half the price. Rightio, you decide that you want 1,000 shares. $150 each at 1,000 shares is $150,000. You've got $50,000 saved up, and so the lender provides $100,000. He's willing to go to $105,000, but you just take the $100,000 because that's all you need for the moment. So let's go get our bearings. Because the lender is lending the money based on the value of the share price, she sets a buffer. And there it is in the yellow. And as long as the price stays within the buffer zone and we stay above the yellow line, no problemo. However, if the share price drops below that yellow line, well, now you're in margin call territory. Okie doke, as we move forward, if the price goes north, that's all good. Let's say the price jumps $30 to 180. We have 1,000 shares and each share made $30, so we make $30,000 in gross profit. Yes, we still got some expenses to pay, the interest on the loan, management fees, commissions, etc. It's still a very nice result. Effectively, we've also built a bigger buffer. And the effect of the margin loan? It's magnified our profit. What that means is that if we just used our $50,000, we would have made nearly $10,000 profit. By borrowing, we made an additional $20,000 profit by using other people's money. In effect, your $50,000 has brought in $30,000, so you've made 60% gross on your money. So the margin loan has allowed you to magnify your profit. All good stuff. Now the other side of the picture. The price drops $30 to $120. We have 1,000 shares at a $30 loss per share, so we drop $30,000. Not so good. Worse still, we now have stepped below the yellow line and the warning bells go off. A margin call's made. The sharks are in for a feed. Initially we borrowed $100,000 and that was okay by the lender because the share price was $150. But now that share price has dropped down to $120, the maximum available loan is $84,000. So they want their excess back. They want their $16,000 back and they want it right now. You've just 24 hours to fix it or they'll sell your shares. And selling your shares when the price has fallen, it's really not the best time to sell shares. So if you were to liquidate your position right now, you'd get $120,000 for your shares, you'd pay back your original loan, $100,000, and that leaves you with $20,000, less the interest, less the expenses. So you've lost at least $30,000. Not good and all forced because of the margin call. Okay, let's summarise. Lending on margin magnifies your position. It either makes your profits bigger or it makes your losses bigger. If you do get a margin call, you've got to find extra moolah in a hurry to pay the lender. You've either got to sell part of your investments to raise the cash, or you've got to give the lender additional security in the form of more shares or property. So as you can imagine, getting a margin call is something that you really do want to avoid. Okay, as we tie up the session, the best thing you can do is to avoid margin calls wherever possible. And here's some tips. 1. Research. Get a really good understanding about what you're actually investing in, how volatile the company, the industry and the marketplace is at the moment. Don't borrow the maximum that the lender is offering. The less you borrow, the less exposure and the greater the buffer before the margin line call. It also helps to have some spare cash at the ready just in case. Diversify. Spread your money around different companies, different industries and even different markets. Margin loans allow you sometimes to capitalise the interest in good times, sort of like paying interest on interest. So when the shares go up in value and you have a bigger margin, you can borrow more. Whatever you do, don't do it. Pay your interest bill every month. Now, as with all investments, this is not a set and forget investment. No investment is. Stay tuned, keep an eye out, and stay interested in the market and how your account is travelling. And finally, shop around. Speak to your advisor, see what's out there, look for cheaper rates and other forms of finance, including equity loans. Okay, well that's it. I hope you enjoyed it. If you did, please subscribe, comment or click the like button. Tell me what you think and maybe what you'd like to hear more of. This is Tony from AdelaideFinancialPlanning.com.au and catch ya. Cheerio.